Hello, everyone. Matt Luciano with Orchard Grove Capital, my own firm. We just, as a brief introduction, do merchant cash advance, act as an outsourced CIO for some investors in the space. We invest across a few of them. Some director at Bank of America for a few years, and then 10 years I was with Air Asset Management as life settlement company. So why don't you guys introduce yourselves?
Good morning, everyone. Is this on? Hello. You said it in the on button. Is it on now? No.
Distributors on.
I guess I didn't. Good morning, everyone. Right now? My goodness. I guess I didn't pass that test. Good morning. It's nice to see some old faces and new faces. And Bonnie, thank you. You always do a very good event with good content. So I hope I don't blow it about too much. I'm Russell Deacon. I'm the founder and CIO, managing partner of my single family office, ACI Group. Just to give you guys a little bit of background, quickly, we're a British Brazilian family. I'm a former venture capitalist, was a partner in Brazil's oldest venture capital firm. So on single family office, we focus a lot on venture capital and private equity, mostly on the growth capital stage, with one exception that we talk about later. We invest domestically and internationally, so Latin America, US, Europe, and Asia. And we also do quite a lot of verticals, most of them on tech, but we can get into that a little bit as well. Thank you.
Good morning, Ron Gordon. I'm the general manager and sole owner of Noble Capital. Noble Capital focused on digital economy and essentially a new version of BlackRock for finance. My background was in the product platform at BlackRock all the way to 2008, and prior to that, so pretty much my full career was with them, and before that aerospace, in the advanced design science, so digital economy is a big thing. So focused right now also side door finance, which is really a B2B2C, B2B2B, cradle to grave with our own entire structure, what you just saw. But prior to this would be very applicable to what we do in terms of monetizing those clients coming in and be able to provide liquidity and loan facilities. In addition to that, so think of it as new era finance for banks become the facilitator from a regulatory point of view, but the lenders and the aggregation can be fully customized on the individual, essentially e-commerce, digital economy. This relates to being able to deliver other services, financial benefits, wellness, and edtech, and other forms of enhancing the relationship between employer, employee, as well as customer and providers. So that's really the overall thing. On the impact side, we're focused on renewables, storage with DC, Solid DC, and we're pretty much on the entire energy production using technology and deep tech. So I'll leave it there. I think there are other things we can talk about. We are primarily investor builder, meaning that we put our money down with our own efforts. We're not so much allocators, pretty much not to be involved in it.
Okay, we have two more. Mauro, you want to speak first?
Thank you very much. Thank you for the opportunity of having me here today in this panel. My name is Mauro Andriotto. I'm coming from the investment banking and the advisory field. I'm also an adjunct professor in finance. Today I'm based in Switzerland, where I'm involved in a private equity investment from different perspective and at the different levels. At the venture capital level, as an advisor, for the Swiss government as an expert at the Swiss, the Swiss Federal Agency for Investment in Innovation that every year approve investments in the field for around $500 million, and at the family office level, where I'm a partner in 2 different family offices based here in Ticino. One that is more opportunistic and focused on traditional investments and traditional structures and products, BS and MC, with the 5 billions of assets under management, and another family office where I have the specific role of introducing tokenization in the investment process, and where we are tokenizing funds based on real estate investments. Thank you.
Gaurav Mehta, why don't you tell us a few things about yourself, where you're located?
Yeah, sure. Thank you. Yeah, Gaurav Mehta. I'm the managing partner of Mesha Capital. We are a healthcare-focused private equity firm based out of New York. We do a mix of growth equity and buyout. So even for pre-profitable companies all the way through highly profitable companies. My personal background, 20 years experience, 18 doing deals and investments. It's a pleasure to meet everybody and look forward to panel.
Okay. Why don't we just get right to it then? We're coming into the new year very fast here, and we'd like to get everyone's outlook for 2025 and maybe some sectors you're focusing on. Gaurav, anything else? Okay. Why don't we start with you, Gaurav?
Could you repeat the question? It was a little bit hard to understand.
Of course. We're coming into 2025 very fast here. Are there any sectors or subsectors that you're identifying and seeking to allocate more or new money to?
Yeah, absolutely. Look, I think so. As I said earlier, I'm kind of a healthcare focused shop, so I can tell a little bit about sort of the where I think there's going to be opportunity within healthcare. So for 2025, there's been a lot of discussion, over the last 15 years around value-based care. And everyone's talked about value-based care, and that's when they talk about it, they talk about it in the context of seniors. For those of you who do not know what value-based care is, it is a concept of it's the concept of having a provider go at risk for costs associated with a patient's condition and their care. And so it's basically taking what the insurance risk normally would have been and putting it on the provider, who then manages the cost through kind of like an ACO of some sort, accountable care organization, and sort of tries to make profit off of that, right? And so there are a lot of different programs. We don't need to go into detail about that. The one thing I will tell you is that I think the self-insured employer market has been largely ignored relative to the senior market. And so I see 2025 being an opportunity for a lot of investments and bringing forward the self-insured employer market or the commercial insurance market. All of us probably in this room, most of us in this room who may be still of working age, and really figuring out ways to reduce the cost of care while improving the quality of care. And so, as we think about value-based care 2.0, I think you're going to start seeing that matriculate more and more into the commercial market, a movement away from fee-for-service today to this value-based, sort of pseudo value-based care, but more appropriate for the employer market. So that's one area where we're spending a lot of time in, and we think that's going to be a big hot area for 2025 and 2026. Other areas of healthcare, which I think are interesting and continue to be interesting, are pharma services, pharma IT. I think with the advent of artificial intelligence, we are just scratching the surface of what the applications can be, particularly to healthcare and drug discovery. And so you're going to see increasingly more investment opportunity in that. The key as an investor is really being able to unpeel the onion and identify those who really, truly have a robust value proposition, where the AI tool is doing something really, really interesting, and they have the right relationships to be able to deploy it rapidly and quickly. This is a what I'd say a greenfield. Obviously, AI is a big greenfield. It's all about a land grab, and so the key is being able to pick the right horses. Those are just a couple areas we think are pretty interesting.
Mauro?
Yes, as a forecast, we believe that the global volume of alternatives will increase in the next few years, standing at around 30 trillions by 2029, from around 17 trillions today. And in this view, we, in particular, we believe that private equity will be the fastest growing asset class, growing from 6 trillions to around 12 trillions. And the growth will be mainly fueled by private wealth, as institutional investors today are mature investors, and in order to get to that level of 30 trillions, we need to focus on private marketplace, as for example, small family offices. And the reason why we believe there will be this type of growth, there are several reasons why we believe that there will be this type of growth. As in the past, the possibility for private investors to join private equity was actually limited, as LP structure is not made for small investors. But today there are at least three main reasons that can allow this type of growth. First of all, there are products, traditional and innovative, as for example also tokenization, that will allow individual investors to get an easier exposure to the private equity market. And the second reason is the technology that is helping in delivering products to the markets. And the third one is that there is also a will from the big investment firms to chase this type of capital. If, for example, you read early announcements from KKR, BlackRock, Carlyle, and so on. And also, if you look at the type of products that they are offering, for example, on their websites and on their commercial materials, and also if you look at the type of investments that they are doing, so we are bullish on this asset class.
Mauro, are there any sectors you're specifically focused on?
Sorry, the audio is very bad, the audio that is coming, because there is a pretty strong
Are there
echo.
any specific sectors?
And sectors where we are bullish on technology, even if in the DACH area, so Germany, Austria, and Switzerland, in the previous year, there has been a decrease of interest in this sector. We believe that in the future, technology will create new opportunities. In particular, we are interested in fintech and technologies that focused on financial services industries, artificial intelligence, blockchain, platforms, clouding, and digital in general. We believe that the key will be the possibility to use technology to enable new financial markets participants. And second, we believe in tools that will make easy for market participant, for the actual market participant, to exploit the power of digital technology. Let's look, for example, at what happened in recent year at the beginning, when you had IT infrastructure complexity, and there were big firms managing internally this complexity with developers writing code and custom-made solutions. But Today, there are two main key factors. One is interoperability, that it asks to be dynamic and to adapt to a quick changing environment, pushing companies to use third-party solution. And the second one is automation, because there is an increasing need of, and a new opportunity also of looking for new efficiency solutions that can decrease cost and increase productivity at the enterprise level.
Thank you. We'll move to Ron.
It couldn't be the best, better lead for me to start. I think the key thing is we are at the very beginning of what I consider digital economy, because everything ultimately comes down to monetization of data, delivering services, and avoiding having to build the same thing 10 times over. And so with technology today, you can have an A to Z, cradle to grave, eco platform where you can deploy that in the middle of Africa, deploy it in sub-Saharan Africa, connect the merchants, the SMEs, the government, the financial providers, both the service side, the trusted aspect of that. Everything I said is really Web 2, it's not Web 3. Don't take me wrong, because you got to start out with that trusted network. And the technology available today from essentially Azure or AWS, wherever you go, and building the data lake and building AI, BI, and building interfaces that are interoperable, and ability to connect payment systems and really be a B2B2C connector and deploy funding far more efficiently than any finance or bank or private equity today, by being very selective about how you would like to deploy that one. Obviously, the impact is for more when there are no other alternatives. India, Africa for us are brand new markets where transparency becomes a way to reduce the cost of capital, meaning that BlackRock or KKR or Apollo would be willing to come in, deploy money in our interfaces, and be able to have either private equity or private debt or any form of utilization. Ultimately, anything you look at, it has the innovation part. That is the growth engine. It doesn't matter whether you're in ag, you're in healthcare, you're in education, but ultimately it has to touch the customer. And the customer, the delivery, and be able to finance that is really the key thing. I look at asset management 40 years ago, and everybody was building their own systems. And then I look at BlackRock after 40 years, they're one of the largest because they integrated everything so it's one platform, no matter how you do it. So transparency of information becomes the key. And I think the opportunity there, at least for us, is to connect everybody who is presented here somehow into our platform and be able to leverage them and give them global access.
So let me, again, to that, sorry about that. Let me ask just before I make my comments, because I think they're very helpful. I want to complement what the other panelists said. How many in this room are allocators to private equity venture capital? Okay, and how many are fund managers here? Super. So I'm going to make my comments a little bit more macro down to what I think. So I think we've had some, obviously, a bit of a winter. Unfortunately, in the last 2 months, I've had 3 distributions of funds, so I think it's pretty much strong. And I think we're going to be in a low interest rate environment. So all on a macro level, I think that's very positive over the next couple of years for the industry as a whole. What we've done as a family office over many years, probably 10 years ago, we started shifting more to the earlier stage to find more alpha. And the reason for that is the following. If you look back at some of the IPOs, Google went public at $1 billion. Uber went public at 52 billion. Apple went public at 300 million. It's quite a change, no? So we've gone into much more growth capital, venture capital, earlier stage as well. And that's where we found very good opportunities. We're underwriting funds basically on venture, early stage venture, 5X and up. We co-invest with these managers as well. We've known them for a long time. So basically the portfolio companies have been coached well, couple of years of training, couple of years of growth, and usually in the smaller funds, then these funds cannot invest pari passu, so they come to family offices to complete their rounds. We found for us and our family office that's worked very, very well. The trends that I think are easy to see. We've invested in blockchain, we've invested in deep tech, we've invested in climate tech, we've invested in AI. I started investing in technology as a venture capitalist in 2001, so technology has been my friend for almost a quarter century, and I think will continue to do so. If you go to a chief investment officer and you bring to him a product, an enterprise solution, whether it's AI, deep tech, blockchain, he doesn't care, or he or she doesn't care. If you bring it faster, cheaper, and better, that's all they care about. And so things are merging, which is good. When technology was very prevalent, it's even more so. So it's all about the execution, it's all about finding the managers who can execute, and that is, we've invested probably 70% of our money in North America, excluding real estate, because that's one of our core businesses, but on the private equity side, 70% in the US, we've done India, we've done Singapore, we've done Europe. So again, there's pockets and sleeves you look for, and you go drill down into finding the managers. And we like when we invest in funds to have opportunities to co-invest with these fund managers on the next round. So that's worked for our family, and we can be a little bit more alpha seeking, because we have two underlying businesses in the British Brazilian family. We're a real estate developer in Brazil, and we also own farmland, productive farmland, rice and cattle, so very different. And that allows us, given my venture capital background, to be more alpha seeking. Every family office is different, but that's the model, and I'm happy to discuss with people if they'd like to learn more. Thanks.
Okay, you touched on it, exits. Do you see more IPOs coming in 2025? I think we've been in a little bit of a lull this year.
Yes, I do, but you also have to realize that most of people's returns and exits are not from IPOs, or strategic sales, or M&A activities. So more based, more on the ground, that's much more important. I'll give you an example. It's quite phenomenal. I go to a lot of international private equity events. There's a very large event, Super Return Berlin, it's the largest in the world. They do events in Asia, Singapore, etc. 2 years ago, they did a survey, 58% of the LPs were wanting to invest in China. Last year it was 3%. Wow, huge change. Where's that money going now? India, Southeast Asia, although I think South Asia is 4 or 5 years behind distribution, but if you look at what's happened now, for example, in the Indian market, there's now distribution on the M&A level as well, and that's what is become self-generating. So the IPO is the headline, but you gotta go down another level to see where that's what drives the returns, in my opinion.
Hey, Russell, quick question on India. Are people investing in India, or are they investing through Mauritius into India? Do you know that
Yeah, so Mauritius is one of the jurisdictions that most of the Indian funds use, but you can invest in India through Delaware, through the Caymans as well. So what they usually do is do offshore vehicles, and the Indians like Mauritius, Southeast Asia. Obviously, most of us in the Western Hemisphere, we do Cayman, we do Delaware, and you can do that easily. So what's happening is the distribution. I went to India 2019, said it was too early, didn't do anything in terms of a business trip. I've been there before. And then in 2022, we decided, we found a manager, they had $1 billion on a management, they had distributed 800 million. And that was the difference over the next 2 or 3 years, distribution started. So they've gotten good, it's British law, so that's helpful.
From a, I think what you have to think about, the world is really the big allocators to private investing with the direct access to the company. So there are many companies that are worth over 550 billion. They love their cap structures. They like the people they're working. They can go back and tap into that. And, for them to go public is ultimately lose a very big advantage at that point in terms of being able to have very much transformational impact in the businesses that they're in. And they don't want to be, still don't want to be keep growing. They don't want to be bound by analysts that don't really understand the business or investors that are retail for other purposes. So I think the fact that you see less IPOs is not because perhaps they're not doable. It's just that the issuers that have good sponsors, and then, they can, as was pointed out, I think with some people, there's secondaries going on. The secondaries really is a mechanism for these people to stay in the private market and not have to go to the public market, because I think many of these secondaries can actually easily go to the public market, but they don't like the kind of work that they have to do to get there and be able to retap it. So our view is that the advantage of a public versus private versus public, is getting bigger and bigger because they can really strategize, bend right, left when the road changes. The smart owners or founders are not necessarily looking at, and if they want liquidity, I think the secondary market liquidity, although it looks pretty meager right now, I think 2 or 3 years from now, you'll see that a lot of that is tier 1, tier 2 access to the cap table. And then there are people who actually are on the cap table, they're making influences, and they have chunks of capital. So you're seeing a whole lot of angel investors that become essentially ability to asset managers, because they end up effectively raising money to invest more in their winners. So if you're a knowledge-based investor, I think you would probably sway that way. That being said, I think the family offices and the pension funds and others have a lot of catch-up to do in terms of being able to take advantage of that channel. So my personal thing is that you're going to see less and less IPO and more the type of things you see with, for example, Tesla. With their other ventures, they're doing $50 billion initial raises in about less than a year and a half, because information is highly leveraged.
Gaurav, why don't you touch on that and maybe add in, some thoughts on the regime change and if that's going to impact some mindsets.
Yeah, sure. Look, I think it's an interesting question. The public markets and whether the IPOs are gonna pick up or not. I think at the end of the day, investors are investors, and they are gonna look for the best possible exit. And whether it's a simple decision, can I have a better exit going public with a high probability of uncertainty to close, or can I have a better exit through a sale of the company? And so, the question around that is there's global, there's macro and micro, so there's no easy answer. What I would say is, from my experience, that I think, having done, dozens of IPOs as a investment banker, I would tell you that, my thoughts are that interest rates are going to be the biggest driver of the public markets opening up or not. I know that might go in contrast to what the other speaker said. But generally speaking, right now, if I'm an investor, I can go put my money into a private credit firm or into some sort of debt securities at a rate that gets me to, just think about it from a muni bond. I could do a muni bond right now. And if you're at the highest tax bracket of 52% on ordinary income, you're getting basically a 5% or near 5% yield tax-free, which is in real dollars, if you're at the highest tax bracket, like a 10% return, basically risk-free. right? And so the markets are, in my opinion, you have this outflow of capital that would have normally gone into the equity markets that are now going into credit, where they can get just as good, if not better, returns than on the equity markets. And so until rates come down to a point where they are, it makes more sense again to get back into the equity markets, I think you're going to find that it's challenged we'll have a challenging exit market, both on the public side and on the M&A side. And so, until that changes, it's going to be challenging. Now, let's talk about the Trump administration really quick. Now, I think the Trump administration, while the market's rallying, because we're likely to see better, sort of regulatory environment for businesses. One of the things that, that you don't hear too much about, but we should be thinking about is are his policies inflationary? And if they are inflationary, then you should expect rates to continue to hover higher. And so I don't necessarily share the view of some of the panel members that we're going to see rates come down. I think there is going to be, we have to wait and see if tariffs actually happen, and we get to an easy monetary policy, which I know is what Trump wants. It could cause inflation again to kind of come back. And so again, I think rates are going to have a bigger influence on what we see both in the public markets and private markets as it relates to exits.
Maura?
Yes.
Take this question from Europe.
So we see an opportunity where in the last few years we have seen in general a lack of distribution, both in venture capital and private equity investments. What we have today are LPs looking to generate a distribution from their private portfolio. And I do not know if this is going to take an increase in IPOs, but for sure we see opportunities in this strategy. We have seen indeed many cases of a portfolio restructuring in order to see which part of the portfolio is best priced, where the liquidity can be generated from, and so on. So we see the need of LPs selling a portfolio of companies or fund in order to generate a liquidity event. And on the other side, we see also, for the same reason, actually, GPs looking for liquidity events in order to satisfy the need for distribution of their LPs, which actually is what is a single asset continuation vehicle. This is interesting because in the secondary market, we expect at the end of this year a volume of around 160 billions with a CAGR of 16% over the next eight years. And this is particularly interesting if we consider that around 10 years ago, this number was around 10 billion. So we believe there will be this continuation of the trend.
Can I add just on that? I forgot one big factor. Private debt in the last 15 years has been another way private equity firms have provided income and cash, but continue to stay in the private sector. So there is a third alternative. So if people need liquidity, need income to pay for the expenses, but they still want to be making a long-term bet that technology will deliver far more than perhaps the public markets will. Therefore, you can continue. So you see majority of private equity firms right now, their actual income is higher on the private debt side than their traditional private equity business. So they've all been building out. BlackRock just also announced another acquisition on that sector, and they're just moving pretty aggressively on that.
Okay, we only have about 10 minutes left, so we'll move a little faster here. We'll start, Russell. Are there any trends here with regards to a lot more baby boomers and how to play off some of that senior market?
So one of the areas that we actually looked at, and we've invested in a fund, I think is the only fund that I know of that's focusing on solving dementia and Alzheimer's, but it's a dementia focused via the infrastructure. So they're investing in hospitals, they're investing in well-care centers. So it's a private equity rollout strategy. They're also investing in this, how to make these centers more efficient by investing in technology, the SaaS and the AI. So, which I didn't realize until we started to dig into 1 out of 3 people now going forward will suffer from dementia or Alzheimer's because we're living longer, we're getting more unhealthy. So it's a real problem. And so we look at that as one of the, how can we, we do a lot of, not because we want to feel good, but we want to solve problems, we want to make money. We do quite a lot of impact investing, and that's an example where we can have hopefully a positive impact and have very positive returns as well. So that's actually the last one we just invested in, specifically looking at the aging population, looking at the increased problem of dementia, Alzheimer's, and that's how we found our opportunity.
Ron?
What is the name of that fund?
Angeliki, Angeliki. Happy to share with that with us, but we specifically said, what can we do with that trend? And that was to answer your question.
Thank you.
Yeah, I think in general, anything that relates to longevity, healthcare, senior housing, and insurance-related annuity income, these are, again, as less and less, as more and more people want to make sure that they're preserving capital, but at the same time now income. I know we're right now at a point where you can get from public market enough yield to satisfy yourself, maybe perhaps, but long term, if we can solve the inflationary aspect of things and expanding growth, I think the interest rates trend. My personal view is that they're not going to be so much on the rise because unemployment and a lot of other things are there. For example, I'm looking at India. If you're in IT, you think they're doing great. A lot of them are out of job. A lot of people, we can actually pick up quite a bit of technology resources in India today because they can't get jobs because it's become level playing field, right? So in that regard, I think technology is a good anti-inflationary tool, and that will lead to saving is a very important matter, and then alternative debt and anything that solves those issues will be very much in favor.
Gentlemen, on our webcam, a couple minutes each to the same question. Opportunities with senior care, silver care, aging.
Who would you like to go first?
You. Be great.
Okay. Yeah, look, I think obviously healthcare, being a healthcare investor, there's a lot of opportunity in the sector right now, just given the aging population. I'll bring one up that's maybe a little more not as well or not as discussed as some of the more obvious care situations, and that is longevity. And there is a large field in longevity that is rapidly growing, driven by just some press, and I forget the guy's name, but who has like, I think he's like 60 or something, and he's got the metabolism of a 28-year-old. There's a lot of investment in that vertical, and this is like supplements, this is diet, it's holistic in view. And you're starting to see funds emerge that focus on it. And not to, sort of tout other firms that are around this, but I mean, I think, Tower Capital Group is a group that recently launched just maybe a year or two ago, focused entirely on what they call generational investing. and it's pretty broad, but it does have a big component around longevity as well. So without going into too much detail, what all the different subverticals are, longevity, you can Google it. There's a lot of information on it. But it's a rapidly growing industry that's got, high double digits, CAGRs in a lot of the subverticals.
Mauro, we'll finish up with yourself with the same question.
Well, regarding sectors, if that was the
Related
question.
to longevity, yes.
Okay. We see some opportunities regarding consolidating businesses. Actually, we are lucky to be at the center of Europe, so we can look with interest in opportunistic acquisition in Germany, in France, and in Italy particularly. I'm originally Italian, so this is the market that I'm looking in, and Italy has some structural characteristics that for some sector makes Italy an interesting target, and sectors in Italy we are looking for are luxury, are food and beverage, and fashion. In particular, Italy is characterized by a high percentage of small and medium-sized enterprise, many of which are family-owned, and they lack the scale of competing effectively in global markets. This is also taken because of the family-owned structure, the problem of transition between different generations, because succession planning has historically been a weak point in Italy, and the businesses face difficulties during generational transition. This is going to open a pretty big opportunity for opportunistic family offices and funds that want to invest there. Also because I would say that in the last few years, the country has shown an economic resilience compared, for example, to Germany, that is compared to the downturn of Germany, which reinforced the attractiveness of investing in this country in the Mediterranean area. Furthermore, as I said, there are many fragmented markets where a strategy of consolidation clearly can generate an important return and an alpha positive strategy.
Thank you, Mauro, and thank you, our panelists.